Good morning, this is Dave Toth with an RJO MRT Technical Webcast update on the US dollar index, the euro currency, and the dollar yen for Tuesday, October 19th. In yesterday's Technical Webcast, we discussed the bullish divergence in short-term momentum resulting from the US dollar index recovery above a minor corrective high at 70.30. But that given the magnitude of this year's broader decline in the U.S. dollar index, a confirmed bullish divergence in momentum of a more sufficient scale above October 12th's 77.93 corrective high was required to confirm a momentum failure that would define whatever low was rejected as the possible end of the broader slide from the late August high up at 83.56. And by virtue of today's break above that 77.93 low that confirms this divergence, we think that Friday's low at 76.14 is in fact that low, certainly a low in support of developing importance. And until or unless that low is broken, we think it does end a complete five-wave Elliott wave sequence down from that 83.56 high that now leaves the market prone to a larger degree correction or reversal higher that we're targeting for the upper 79 handle area, as this is both the 50% retrace of this entire 83.56 to 76.14 slide and also a former area of major support turn resistance from early August at 80.08. This short to intermediate term proof of strength stems from the long term. The market's rejection thus far of the long-term uptrend shown in the upper boundary or the lower boundary of the past couple of years, contracting triangle range connecting the March 8th low of 70.70 with the November 09 low of 74.17 that cuts across right in the 76.14 area that the market has thus far rejected. With both measures of market sentiment back to neutral conditions that won't inhibit a move either way, we're looking at this short to intermediate term proof of strength as one that exposes a larger degree correction or reversal higher, and traders are advised to act accordingly. In sum, we advise, by virtue of the recovery above both 70.30 and 77.93, all bearish exposure should be neutralized by this point, and we advise traders to look at interim setback attempts as corrective buying opportunities ahead of a move to quite possibly the 79 handle in the days and weeks ahead. Similarly, in the euro currency, by virtue of yesterday's short-term momentum failure below 139.13, the market has stemmed, at least for the short term, the broader bull of this year. But the market still needs to break below the 137.75 corrective low from October 12th in order to confirm a bearish divergence in daily momentum that we believe will define Friday's 141.60 high as the end of a five-wave Elliott wave sequence up from the late August low at 125.88, exposing a larger degree correction or reversal lower that we think will have legs to the 135 to 133 range. The 133.30 area is a 50% retrace of this most recent rally from 125.88 to 141.60 and also correlates almost exactly with the former key resistance from August 6th at 133.36 that is now considered new support. While the market has yet to break that 137.75 low, we think it's only a matter of time. So traders are advised to move to a neutral sideline position for the time being and look to interim recovery attempts as corrective selling opportunities ahead of a larger degree move to the 135 to 133 range. We think it's also important, and as we discussed in yesterday's webcast, that on a long-term weekly log scale basis, this rally from the 125.88 low from late August has stopped almost exactly at its 100% progression of the previous 118.76 to 133.36 rally. That could mean the year's entire recovery in the euro has ended and a much larger degree correction or reversal lower lies ahead. And again, by virtue of at least the short-term bearish divergence in momentum, one that's pending, we're on the cusp of a break below that 137.75 low that will complete a larger degree momentum failure. We think this market now has very quickly become vulnerable to a larger degree correction or reversal lower. And finally, looking at the dollar yen on a monthly log scale chart here, obviously the secular trend has been down as the market is near the all-time low from April of 1995 at 79.92 amidst waning downside momentum on a long-term basis and historically bullish sentiment according to the yen futures that typically companies' major basing and reversal processes. Obviously, on this scale, the secular trend remains down and should not surprise by its continuance. Looking here at a weekly log scale close only basis, it shows the dominance of the broader bear trend in the US dollar. However, especially with historically extreme levels of bullish sentiment, according to the yen, it's not hard to count a nearly complete 5-wave Elliott wave sequence down from the March 10 high weekly close at 94.61. We're confident that the market is in the very tail stages of a long-term bear trend, and that over the course of the next weeks or perhaps even months, it'll be a longer-term basing and reversal threat. The market will put in a major base and reversal. But clearly, looking at a daily chart here, the market has yet to show any signs of the strength required to even expose an interim correction, let alone a reversal higher, with strength above at least the 82.87 former support term resistance from mid-September required to arrest this sell-off, suggests that this latest phase of the decline is a completing fifth wave and expose a larger degree correction or reversal higher. On an intraday 4-hourly chart, you can see the 82.37 high from October 11th is the latest and tightest corrective high that we believe this market needs to recover above to reject and define some low that could be, while just a short-term low in support at that point, could be the base of a basing and reversal environment that could be massive in scale and span years. But clearly, we'll need much more proof of strength above recent corrective highs like 82.37 and certainly the 85.94 high from mid-September, along with impulsive behavior down and corrective behavior on setback attempts that likely will span months before we can approach this market more soundly from a long-term bullish perspective. In sum, a bearish policy remains advised in the dollar-yen, with strength above 82.37, the minimum required to arrest this sell-off and expose a base and reversal that could have long-term implications. Please stay tuned to updates on these and other markets on our rjomrt.com website, and good luck with today's trading.